Thanks everyone for being here for the panel. We have all 6 presenters returning. So we have Brendan Cahill at Excellon, Peter Megaw, who is at Reyna Silver, Singh is with us from Discovery, Marcio Fonseca from GRSL, and Ritchie from SilverCrest are all back to go through the panel and kind of have a discussion about the markets in general. It's kind of an interesting day to be to be having this conference and go through Mexico in general. It wasn't really intentional for this conference to be so Mexico oriented, but obviously that's where a lot of the major assets are. So I'm glad to have you all back.
I think we've got everyone working too.
Perfect.
That's good.
Yep.
So yeah, thanks for joining us today. It was a lot of fun, except for if you're looking at your screens. So Tina and I have a series of questions and thematic things that we want to run through. Just before we get started, as many of you know, this is typically a charity event that we do on Thursdays. We're not going to do the BYOB just because this is a little bit more serious, but I would mention that we typically do something in support of Canada or Food Banks Canada. So today, because you all have assets in Mexico, we chose a Mexican charity that's sponsoring communities and families in Mexico that's run by the United Way. So there's a link on the Adelaide website under upcoming events. If anyone wants to make a donation, don't feel like you have to, but anyway, I'll let Tina kick it off with the first question.
Sure, thanks. So obviously we've seen a lot of interest in the precious metal space over the last few weeks, and there's been a significant amount of deal flow and private placements over the recent weeks. And I think 5 of the 6 companies here have raised money during quarantine. So it's been interesting, and a lot of those deals have been oversubscribed. So just curious to know how you've been getting funded. Is it through mining investors in particular, generalists, institutions, or retail? And maybe Brad, you can speak to the way how Endeavour is raising capital that's different from some of the other cycles in the past.
Yeah, thanks for the question, and welcome back everybody to our panel discussion. As the only producer on the panel, although Peter from MAG is soon to be a producer.
And don't forget about Brendan.
Oh, and Brendan, my apologies. Right now he's saying, Brad, what are you doing?
Stop, Brad.
We have cash flow. We typically tap either the equity or the debt markets on an as-needed basis, typically for growth. So we have had an active ATM equity financing available to us now for almost 5 years, and we tap it from time to time, primarily for our growth. My main mission this year is actually, once we get our final pre-feasibility numbers out on our next core asset, the Terronera Mine project, I'm going to roll up my sleeves on debt and subordinated debt financing. So those are both the historic and the forward-looking sources of funding.
And Taj, you just did an oversubscribed private placement. Can you talk about the breakdown of that financing and how much was, you would say, more generalist or mining-centric investors?
Yeah, ours was a bit of a unique one. We already had about 20 in the bank, 20 mil, and silver started catching a bid, and our largest shareholder, Mr. Eric Sprott, called me and said, I want you guys to get more aggressive. And within, a very short time, a couple of hours, the book grew substantially. We didn't need, we did 25 million. It was oversubscribed almost 2 times. We didn't, when the initial idea was not to maybe take that much. But this one was really like a rights offering for us. We didn't go and kind of keep it open to everyone. We kind of, all the large, chunky North American and European institutional investors who've been supporting us, we let them have a chunk. So basically, a lot of people got cut to zero who tried to want to get in, because we just didn't. We cut it off at 25. We left a lot of demand out there, and that's why the stocks behaved quite well after the financing was done at 55 cents, and the stock's been trading around 80 ever since. So we left a lot of demand out there, but this one was really just sort of a rights offering for our existing shareholders. This last one.
Yeah, and I think Peter probably had a similar experience with the oversubscribed financing and the level of interest that is still coming out in the market that you can see the last week.
Yeah, I mean, we're seeing that after the fact. Most of the $6.5 million that we have, Jorge raised into the private company more than 3 months before we went public. So we raised that money during a substantially different financial environment than the one we're in right now.
So just shifting the conversation a bit, a lot of companies obviously in this environment are starting to get stronger balance sheets, not only from private placements, but better cash flow as a result of higher gold price and silver price as well. Do you think we'll see increased M&A activity in the coming months? And are there any jurisdictions that you think are more attractive and ripe for M&A?
I believe for sure we're going to see more and more of this kind of really activity, because I've seen, I believe most of the panelists have seen that large mining companies are starting to divest non-core assets and looking for low risk for companies like the ones presented here, looking for low risk jurisdictions. In the case of silver, it's hard to be away from Mexico. It's the largest silver producer in the planet. If you're looking for silver, that's a place to be. Although we have seen some challenges in Mexico at federal level with the new government, I believe it's still a very attractive jurisdiction to be in the silver space, in my opinion.
Yeah, and I think on the M&A side of the last couple of years, we've seen a lot of divestitures and assets changing hands versus outright acquisitions. Maybe Brendan, you can touch on how you think that those structures will look going forward.
Yeah, I mean, it's a bit of a free for all right now, I think from our perspective, we actually just acquired a gold asset in the Western U.S. And you see, actually, it's really interesting being in the silver space right now. And I think the companies here today are going to see significant torque over the next while, because there just are so few silver names out there. You have SSR acquiring Alistair. They've got one silver asset left. So the majors are really trying to, divest their silver assets as usual, right as we get into the flow of a serious bull market. So I think, keeping significant exposure to silver or entire exposure to silver is a great idea. Buttressing that value with gold, and Brad and Chris have good gold components in their deposits. That's really kind of the horsepower through the entirety of the precious metal cycle. But certainly the fireworks come from silver. And, I think maintaining that exposure is going to be key to really see the full, really fully experience this bull market that's coming. So we're focused on, driving Platosa forward, our operating mine in silver, moving forward the Otis Gold project, and then doing some silver exploration as well, which is tricky to find great silver assets, of course, right? And we've gone over to Saxony in Germany to revitalize an old district that's basically the size of Fresnillo.
Do you think that the best opportunities are coming out of the majors?
Is that for me as well?
Anyone, or where are you finding the opportunities?
I mean, if you look at the best returns in the space right now, it's SilverCrest and say Great Bear, right? And those are effectively new discoveries. So I think, one of the opportunities out there is doing good exploration work and trying to make discoveries. And there's been so little effective work done in recent years that those opportunities are there. They're difficult to find, and maybe you have to go to a more difficult jurisdiction. But even in Mexico, there's just so many opportunities. Get the drills going and make discoveries like SilverCrest. And there you go, 15 cents to $13, not today, over the course of 3 or 4 years. So, and we see those kind of returns in the space, and that's great. That shows that the space is getting healthier again when people are craving those discoveries, paying for those discoveries, and sticking with them as they go up 10, 20, 30 times.
I would add there's a really big disconnect between the asset management business and trying to operate a mining company. The timelines just don't add up. The asset managers need monthly, quarterly returns. And quite often in the mining business, you're making decade-long decisions. For Eric, our CEO, and Rosie, and they love to find the new treasure. They would love to find a piece of property and drill it for 3-4 years. And that might not yield anywhere near the same sort of returns people want, if you're a $3 billion company. So for the majors, they don't necessarily they haven't been given the latitude from the investors for a long time to spend a lot of money on drilling. And I think that'll change now. So they need things to move the needle quicker, but those are more expensive and they're higher risk. So again, the timelines are very different. So I don't think the majors have the debt problems they did in the past, especially with interest rates coming down where they are. I don't think they're in the same need to divest. I think those pressures came post the global financial crisis, not now. So if anything, they're probably holding on to some of the things. I mean, in Pan American, when they bought Tahoe, it was the Timmins assets that were seen as like, oh man, we have to take those. And now gold's at $1,750, and those are gifts from the gods. So I think if you can get a producing asset, guys are trying to hold on to those things. It's whether people are going to be given the latitude to go out and find the new discoveries, and whether the timelines to do that are going to be acceptable for people. And then the other side of that is just MOEs. Paying 30, 40, 50% premiums, I get those questions, if someone's going to bid 40, 50% for you. And I'm like, I just can't, those things are very, very, very tricky to do. We saw what happened with Detour and Kirkland Lake. I think you're going to see a lot more of sort of the low premium MOE type synergistic opportunities and sort of do the right thing. And it's going to be the original discoveries that are going to be the real needle movers.
And Peter, I'm curious to know what your thoughts are on Mexico versus elsewhere, I guess, because you seem to keep coming back, but it seems like you're still able to find some significant deposits in the area. Have you looked outside Mexico, or are you just seeing too many opportunities there?
I've looked all over the place, but you keep coming back to Mexico. It's the best place to be for silver, and I would certainly second the observation that the best opportunities in our business are the ones that we create for ourselves by doing exploration, that it's getting out and finding something new that really changes, that really generates the big return for the shareholders. As Chris said, they're not expecting, this isn't something for a $3 billion company, this is for something for a $30 million company to be doing. And then you can get the real multiple on your investment that's commensurate with the risk that's involved. And obviously the geopolitical risks come into play in terms of being, wherever you happen to be jurisdictionally, but you still have to go to elephant country wherever that happens to be, and you got to live with whatever the rules are in elephant country.
I can put an exclamation point on that as well, Peter. In the gold business, there are large companies with assets for sale, and so that is a thing. But in the silver business, there is no such thing. There are no assets for sale to speak of. And so if you can't buy it, you do have to find it. And that's the main takeaway on M&A at silver. If you can't buy it, you have to find it. And so everybody on this panel either is or has been in the finding business.
So how much do you have to delineate an asset, or what production level do you have to get to in this upcoming cycle, do you think, to be an attractive takeover candidate? Like what do you think the majors are going to look for, or consolidators? Or
I think there's a big difference between consolidators and majors, just because the majors don't like silver very much. Mm-hmm. I can remember actually looking for silver in Mexico for Kennecott at one point. What is a company like Kennecott doing looking for silver anywhere? But for somebody, a serious company, so to have $1 billion+ market cap, 10 million ounces a year and resources to do that for 10 years is sort of the threshold to get into the serious levels in the silver business. That'd be
so you commented that the majors don't like silver. Why is that?
They don't understand it. It's too volatile for them. And typically you can't open pit it very effectively. Most of the majors like giant open pit operations that are essentially earth moving operations. And if you look around, there have been very few open pit silver operations ever that made any real money. The ones that have had enough of a gold kicker to pay the bills, and the silver came along with it. So it's an accounting jujitsu whether or not it's really a silver mine.
Go ahead.
I'd like to add a comment about it. As Peter said, like, consider that Mexico is a silver country, right? And all the companies, silver producers, including the one that's in there in this panel, they are diminishing reserves every year. So there's an urgent need to replenish reserves. So defining new resources and reserves, which are attractive for all the producers, is another way for a small company like GR Silver to be placed in a very attractive position, maybe in the next couple of years.
Yeah, for your guys' question, what kind of stage a company? Typically, I think that they like something that's got a resource for sure. Companies getting acquired pre-resource are few and far between. At least at a PEA stage. So resource and a PEA is actually the minimum. I think that a mid-tier or major would be looking at something. And then, yeah, listen, it's the key things again, jurisdiction. And then, as Peter pointed out, there's certain parameters. It looks like 10 million ounces a year, probably maybe even closer to 20 for a really big one per year of silver equivalent is what they're kind of looking for. Nice, decent mine life, at least 10 years. Those are kind of the standard things that the big guys might be looking at. 10 is probably sufficient, especially if it can cash flow a lot. But the big thing is the silver universe there's not many assets out there. And so, you may see some base metal guys come in. We've seen some interest from base metal guys, especially if the deposit's got some base metals. Most gold guys, as Peter pointed out, don't love it, but remember, Newmont's still the largest producer of silver in the world.
They don't set out to do that. They just get that accident.
It just comes with it. I know. Just I know. But yeah, the space is pretty limited.
Yeah, I think it'll be interesting to see what happens. Obviously, we're big believers in a strong precious metals market, so it would be interesting to see some of these base metals or more diversified players coming into the equation. But we've touched on this a little bit. It's obviously hard to find a pure play silver company. A lot of deposits contain byproducts like gold, and silver is sometimes a byproduct of another metal. So in terms of valuing and comparing opportunities as an investor, how do you go about doing that?
Well, I mean, the obvious place to start, and as Brad pointed out this morning, silver plays very well with others. So you shouldn't ever expect to find a pure silver play. They basically don't exist. So it's really a question of, if it's a silver deposit, it's 50% of its revenue comes from silver, or it's a silver deposit if it can fly on silver alone and the rest of the stuff comes along for the ride. That's the way I'd be looking at it. But I'd personally like to see more than 50% of the value coming from silver before I call it a silver deposit. And I mean silver, not silver equivalent.
Chris, I think we were discussing looking at large caps and comparing silver companies to historical values. Do you have any thoughts on where we stand at this point in the cycle?
Well, silver tends to lag gold. So I think one of the charts I ran through quickly in my presentation was showing the last 5 cycles how silver did typically lag and then shot ahead and outperformed gold in a significant way. And that seems to be the historical paradox. So I think when it comes to seniors, there's liquidity has been much bigger factor. I mean, we've seen fee compression come in and change the nature of the asset management business, and asset managers have to get bigger and bigger. And that means they have to put more money to work per idea to make their businesses work. They don't want to add more overhead to their business. So, you know, size and liquidity is a bigger factor for those seniors. So, I mean, you know, some of those seniors, some of the senior companies are still struggling to get to 50% silver. They just happen to be big in liquid vehicles. And when the market starts to turn, they're the ones capturing the biggest multiples. So it's, you know, they're putting themselves in a position where they can start to do acquiring. And that's also what's going to be really interesting, you know, to Marcio's comment, you know, everyone's looking for more reserves. You could have a companies or deposits where they're pretty low margin at today's prices. Silver moves aggressively. The stock performs really, really well, but it doesn't mean some of those deposits or companies have the next project in their pipeline. So getting that PNAV multiple up gives you that currency to go out and do something. So it's going to be really interesting to see where the investment dollars want to go and what latitude that gives to the companies in terms of how they're going to decide to grow. Because, yeah, there's some companies out there that are really nice big multiples without pipelines. So you can kind of get a sense they're probably going to be looking a little more aggressively. So I think valuation-wise, it's going to be interesting to see how it plays out, because silver companies tend to get a better valuation than gold companies do. So you're not going to see the base metals or the gold companies necessarily having silver at the top of their list of acquisition targets. But at the same time, these are the ones that are moving the most aggressively if and when the market starts to run. So yeah, I think you're going to have to see a lot of small stuff that's get picked up. I think the sub 100, 200 million market cap names are probably going to be the most interesting from the M&A perspective, because you're playing for the drilling upside that can happen really quickly now that most people have the financing and the cash to go out and really get to put a lot of drills in the ground.
Let's talk about that premium that silver companies have historically had, and why you think that is, and whether you think that'll continue to persist through this cycle.
Yeah, that's basically a scarcity multiple. You know, you can count the number of majors in the silver business basically on your hands. You know, there's 10 or 12 of them, and that's about it. Mid-tiers even less, junior producers even less. The entire family of primary silver producers might be less than 24. So there's a serious scarcity value for pure silver plays.
Okay.
We talked about silver lagging and then overreacting. In terms of the actual silver price, any thoughts on why it overreacts compared to the gold price?
Maybe I could jump in on that one too. If you look at all the metals traded on the options and futures market, COMEX for instance, silver by far has the biggest forward short position. And the reason is that of all the primary metals traded, silver is the one metal that's primarily a byproduct of other mines. And major companies, gold producers, lead zinc producers, copper producers, would rather be leveraged to their primary products and hedge forward their silver. And so from time to time, you see the forward silver position on silver is not only like 100 times the physical position or more. You know, in terms of years of production, you can see seniors going out 1, 2, 3 years with their forward sales. So when the price moves, the counterparties, the bullion banks, have to cover and reset and cover and reset and cover and reset. And that's why silver is so volatile.
Okay, and then shifting more, I guess, back to Mexico a little bit, can we talk a little bit about some of the biggest risks in Mexico right now? And then I think it's very different region to region, so maybe we can touch on how policies and even response to COVID has been different regionally.
I can speak to Sonora. I mean, typically, you know, if you were to pull up a cartel heat map You can kind of get a sense that a lot of the activity tends to happen around the borders with Central America and the coastlines and whatnot. More of the money's being made in the shipping of drugs than it is in the actual making of it. So once a certain cartel gets strength in a certain area, it tends to quiet down a fair bit. So there's definitely different areas that are better than others. There's a bit, things do tend to heat up when the economy gets worse. So I think to a certain extent, you might see a little bit more activity here and there. But on Mexico as a whole, from the political, you do see AMLO starting to be a little more vocal on taxation and whatnot. And again, that's because less than 20% of the population pay tax in Mexico. So it sounds like a negative, but in many ways it's a positive, because you can't bite the hand that feeds you. You have such a small tax base within Mexico, and they have an EBITDA royalty tax where it used to be where a third would go to the local governments, a third would go to the state, and a third would go to the federal. And that's been clawed back where they've taken it all to the federal. So the only real support networks that are happening for the local communities is the work that a lot of the mining companies are doing. They don't have the same infrastructure. They don't have a CERB program for people who are out of work with COVID. It's the activities that are mine driven and the infrastructure that the mining companies are bringing in, the health and safety that we're bringing is kind of almost like a source of a government activity there. So there is rhetoric, but I think they need us and they need our dollars, especially with an uptick in pricing right now. They need to see activity from mining companies to fill their coffers. So I don't actually see, maybe there is a slight taxation risk coming, but I can't see it being overly aggressive based on how much they need the activity and the employment that mining companies create.
Brendan, you've had some experience going through the development process and permitting. So what's your experience been like in Mexico?
Sorry, Tina, you just broke up a bit on the first part of the question.
You've obviously had some experience with the permitting and development process in Mexico, so I'm curious to know what your experience with the government's been like.
Yeah, as Peter says, like from an exploration perspective, it's still for silver, and just generally, I think one of the best places in the world to be. And going from that discovery through the permitting process to development and production, I'd put it up there with anywhere in the world as well. Like it's a pretty clear path. You can work with the regulators. There's a dialogue with them. And that's why you see, operations being discovered and then brought to production in relatively short order compared to, certainly many other jurisdictions in the world. You can be looking at like 5 or 7 or 10 years before you can get a project off the ground. Whereas in Mexico, you can, that's 3 to 5 years, or maybe even less. So, generally from a permitting perspective, I can't say that we've seen a lot of changes under the new government. I think the system seems to be still very supportive for moving projects through development to production.
And just kind of
and that's I think state by state as well. We're in Durango and Zacatecas. There's definitely states in Mexico that are trickier, just like there are sub-jurisdictions all over the world that are trickier. We've been, lucky in Durango and Zacatecas.
Yeah, for sure. Just in terms of shifting a little bit towards the ETF discussion, obviously the gold price is becoming increasingly correlated with the inflows and outflows of ETFs. Are you finding this similar in the silver space? And maybe we can speak a bit about how you think about a generalist investor holding a silver equity versus the general ETF. And maybe Chaj, will start with you, because I think it'd be interesting from your perspective as a small cap to address owning something like Discovery versus an ETF.
I'd like to actually throw physical into that conversation too.
Well, if you look at the JDXJ, it's the most traded and liquid ETF that provides exposure to the junior end of the market. Predominantly, it's made up of intermediate to large gold producers, actually. So Kinross is in the ETF. The market cap is like 10 billion, over 10 billion. The top 6 stocks are all intermediate or large gold producers, and they make up 30% of that index. So you don't really have exposure to the juniors where you get the real multiple jumps, as Peter mentioned before. And you don't really have much exposure to silver. So the real way, really, in a silver bull market, I don't think there's any comparison in terms of kind of torque and leverage you can get compared to being with a silver producer, developer, explorer.
From my perspective,
Yes.
I worked like financing companies for 10 years on a trade desk. One of the issues that we encountered was ETFs, like they don't participate in new issue business, right? So in certain times in the market, it's hard to finance because the only buyers are ETFs, which clearly none of you have experienced that right now, being able to finance over the last little while. But yeah, ETFs are kind of a double-edged sword from my perspective anyway. It's good to be included, but it's bad when the market turns. But sorry, I interrupted you, Bradford.
I was just going to comment on the difference between the gold ETFs and the silver ETFs. There's a very distinct difference, I think, clear to all. The money that goes into the gold ETFs is typically institutional money, and it's a little bit faster money, if you want to call it that, hedge money or cyclic money. And so it comes in and it goes out. And when you look at the metal under management and the inflows and outflows of the gold ETFs over the last 10 years, there was a massive inflow during the bull market and a massive outflow during the bear market. Contrast that with the silver ETFs, and they had a spike from the inception in 2005 to about 2012, capped at, I can't remember, 600, 700 million ounces, and then stayed there through the entire bear market with barely an ounce sold off, barely any inflow, barely any outflow. So what that tells me is that the investor in silver is very, very different than the investor in gold. I think you're seeing much more family office, retail presence in the silver ETF compared to gold.
The GDXJ is a really good hedging vehicle for people playing gold equities. And that, you know, that makes it much more prevalent. So I think Brad's spot on in terms of if we do see a silver market, it's much, much smaller. And again, one of the charts that I had in my deck was just showing that less than 1% of the global market is within precious metals, you know, and silver is just a fraction of that, you know. So if it's already a stickier part of that small little piece of pie, the fact that we have had sort of a 10-year hangover and now we're seeing one little blip, and you know, this COVID has woken up all of the sort of money printing machines around the world that were already working pretty hard, and all the conditions are right, but we haven't seen the fund flow yet. I mean, I think to me that's the big part of the conversation of when do people feel like they're underweight if they don't own it? When do they feel pressure to own some of this stuff? And if that's the case, you know, if we go from 1% to 2% of the global market, you know, that's a massive move that will create a positive snowball effect. And you know, today was like the first wave of liquidity washout, just like we saw last time. I mean, our failed deal that we did a month or two ago is a perfect sign. Everybody wanted it because of how gold and silver would perform because of all this activity. But step one is usually a washout, you know? And I think today was just another washout, but all the backdrop, all the conversations, all the Fed commentary was about as supportive as you can get. We just need to see that reallocation. And if it's a sticky sector, which is stickier than gold, it won't take nearly as much to move the dial.
Yeah, it's interesting. I thought with the announcements yesterday and the price action in the broader markets today that we'd be seeing a lot of outperformance in the silver space, but I don't think we saw that from any of the silver stocks on my list today anyway. So you think this is just a delayed reaction? And what if yesterday wasn't it to get investors in this space? What do you think will it take?
I'll give one more comment. I'll let other people speak more. But if you remember the washout we had about 18 months ago, I think it was a December or January where we had that little flash in the pan. I have a few friends that were in these big levered hedge funds where they're using 8 to 10 times leverage, and they have very, very small tolerances to volatility. So if you get outside of your normal volatility bands, you have to sell. Like, you just don't have the ability to hang on in down days. So they just exacerbate these big moves. And we've seen this huge wave come back in the market in the last 3 or 4 weeks, back to all-time highs. And this was just the day one of washing that out again. There's no reason the market should have charged back that way other than just crazy amounts of leverage. So I just think, yeah, this was just a washout of some of the overly levered hands, and then we'll see where the money comes back for a more stable run.
I think like looking at this washout today versus what happened in March, and then comparing it to what happened in 2008, where it was a very, very extended period. You know, when the market really fell apart in March, we were all scared that, oh, we've got another 2008 on our hands. We're going to see 3 or 4 months of just, you know, dropping metal prices, dropping equity prices. But the rebound was really in a couple of weeks, right? And so it's going to be interesting over the next couple of days to see if this is yet a shorter duration kind of washout, and if the money starts flowing back into the precious metals and equities on an even quicker time frame than the last time in March.
Do you think the retail investor really understands the amount of damage that's been done during COVID? Like, we've been seeing, I mean, the banks had some terrible results and they started trading up. Obviously, they pulled back today, but you're seeing people get back into the airlines, buy bankrupt companies. Doesn't really make sense to me. So I don't know if you guys can make sense of any of that.
I don't even think governments know.
Yeah, I mean, I think the market is being run by, you know, 25-year-olds with spreadsheets who push in 0 for their discount factor, because that's what the treasury rate is, right? And they're like, everything is worth billions of everything. It's an infinity, right? And it's just very hard to traditionally value a market when all the numbers, the base inputs, are completely warped right now. But then when, you know, I was thinking walking around Toronto, and there's no Blue Jays, there's no TFC, there's no Wolfpack, there's no, there's nothing, right? There's no Argos. So what's going to happen this summer? Like, think of that. There's no Indy. Like, the economic hit of those factors alone to kind of bring them home is just absolutely mind-boggling, and that's happening, you know, across the entire world right now. So how do you model everything all at once, right? And nobody can do it. And I don't think, you know, the Fed coming out is just really recognizing finally, like, things are not good and they're not going to improve for a while. And it's really difficult to actually quantify what the impact is going to be long-term.
So to add to that, I think it's easier to model businesses coming back on stream and people going back to work producing goods and services. It's a lot more difficult to model the absentee consumer. And I think that's the impact that even governments are missing right now. When I walked down the mall here in Vancouver, this was 3 weeks after you know, we went to whatever it is, stage 3 on restriction. It's like a bowling alley. There's more security guards than there are shoppers. It's scary.
Yeah.
Yeah, so obviously I think no one on this panel thinks that things are that great, but that does affect silver in 2 ways. I think it's an opportunity to provide a flight to safety, but there's also the industrial applications, like with the auto industry, that will suffer as a result. So I think Michael mentioned in the keynote that the way to play this is through silver more as a currency than the industrial side of things, and that's going to dominate. But how do you feel about managing and balancing those 2 things?
I would say, again, that the size of the market is so small. If there's just a small amount of belief that comes towards this trade, the investment demand is going to far overtake the marginal hit to the industrial demand. I think that has the multiplier effect relative to the marginal industrial side.
In fact, you can tell that we've started a new cycle from looking at the investment demand. We had an uptick in inflows into the silver ETF starting last August. It stopped abruptly, but it started again. Perhaps more importantly, in the first quarter of this year, we saw a 4-fold jump in US coin and bar demand over 2019. That surely is telling us that Main Street is getting it. Wall Street's not there yet, but they will get it.
I would also say, just to anyone in the audience, if you want to participate, you can put questions in the Q&A. There's one that somebody was asking if we're going to make the replays available, and we will next week. And then we had one question just talking about how would you minimize dilution when coming up with a long-term strategy. I don't know who wants to discuss that.
I actually just had a follow-on for Brad there, just on,
sorry.
On the last you know, when you're looking at like the games being played in the silver market and the long positions and contracts that are out there, you know, and that's partially the producers trying to hedge their byproduct. But do you also see like industries trying to hedge their silver inputs? You know, say the solar industry has an investment in keeping silver prices as low as possible because it's the primary input on solar panels. So I think, you know, in some respects, like a lessening of industrial demand for silver could actually maybe take the lid off that structure a little bit and allow the long-term investor who's interested in silver as a store of wealth, maybe a substitute for gold, actually fly a bit further than it has been able to when there's been this big industrial demand.
Interesting. You know, the precious metals are a global 24/7 spot market. But silver is kind of that transition metal where it's 50-50 monetary and industrial, and the industrial side is growing. I think that the idea that a consumer of silver, a manufacturer, can just go to the market on an as-needed basis, just-in-time inventory, that concept might actually change here in the next 3 years as the investment demand swamps the industrial demand. We might actually see our business evolve quickly to producer contracts, and that would be wonderful for us producers.
Mm-hmm.
Is anyone willing to throw out a price target in the next 6 months or so?
You can call Eric Scott, but
I think there's a few panelists missing for that one.
Yeah, exactly.
But I'd hedge that comment the same way I'd hedge any. It's if you go for grade and your grade is high enough, you don't have to sit around worrying about what the price is. If the price goes up, you're happy. If the price goes down, you're still sleeping at night. And that's why grade is king.
For sure. That drives to margins, right? High margins, for sure.
Yeah, I think it's an interesting time, and we're headed into a really, really great market for silver in particular. I'm curious to know what you think about potential news flow going forward and managing, I guess, analysts' expectations versus what could potentially be some pretty bad Q2 numbers.
Yeah, you've got an analyst managing expectations over here.
Yep.
I mean, like personally, I think that it's fully baked into the market. You know, when we all announced, I guess on April 1st or 2nd, that we were suspending production, the producers on the panel for the foreseeable future, we knew it was going to be April 30th and expected it to be longer. The market really didn't budge at all. You know, the ramp up, it's not immediate. It takes a couple of weeks to ramp up a mine. So Q2 is a wash. It's going to be a wash for the entire industry. I think the analysts understand that. It's getting back to production that's key, and that's going to be, you know, we basically hedged our production because silver went to like $11.50, $12, $13, and now we're back at $17.50. So it was actually a pretty good trade being out of the market when we saw those very low silver prices and then very low base metal prices as well. We're seeing a bit of a rebound in lead and zinc right now too.
Actually, it's a good point related to the silver lag relative to gold. Because we were effectively shut down, not only in Mexico, but throughout much of Latin America in Q2, when the silver price finally moved, we won't actually see that translate into financial performance until Q3, and most of us release our financials at the end of October. So the slingshot move for silver, I think, is going to be late this year. Once we show that we're outperforming gold in terms of cash flow growth, earnings growth, that's when the next slingshot will be for silver.
I would think a lot of your input costs are going to be coming down too with the peso decline and energy prices lower.
Yes, the peso did take a run from 19 to 25, but it's back in the 22.5 range today, I think. And our costs are about 2/3 peso costs. So we did the math. We figured that a 25% depreciation translated into about an 8% benefit on costs.
I would say for the analysts that they're not overly aggressive these days. I mean, for some of the early names, like if you're a small market cap, you do have to sort of use your imagination in terms of how it can grow, but there's no really aggressive price targets out there for silver. We started to see a couple gold targets kick in a little bit, but if you were to see a $20 to $22 silver, pretty much every single analyst would be revising their price decks. All the valuations would start to look materially cheaper. And that means, share prices are going to move materially just to get back to sort of that status quo, whatever that is. So there's nothing really overly aggressive out there for any silver price assumptions. So again, I mean, the analysts are lagging the commodity price moves. I mean, you'll see some 19s and a couple $20 out there, but if we shoot through $20 and analysts start putting $22 to $24 targets, everything's going to start to look really cheap again based on those new commodity prices, which is what the beauty of the commodity price cycle, right? I mean, your valuations can stay in check all the while your stock's going up 20, 40, 60, 80%, right? So that's the holy grail, and I kind of like the fact that analysts are usually a little bit lagging there.
Yeah, well, I think a lot of analysts are just going to stay focused on the gold space for now because it's working really well for them. They get a wider audience, but that's where you can really find value in the silver space when other people aren't paying attention. That's my 2 cents, working on an equities desk for too long. Tina, what else do you want to ask?
Yeah, I mean, I'm curious about, obviously most of us are pretty bullish on the silver price, but what's the risk of it going down, or what are the biggest risks in silver pricing right now? And then also in silver equity investments, which I think is a little bit of a different animal.
So I think there's two systemic risks. One is the one that's been with us always, which is just the volatility of silver. And the second one is related to COVID, that even though many mines shut down, which should deprive supply by various analysts estimate between 25 and 50 million ounces this year. And we're going to see a surge of uptake from manufacturers as they come back to business. But after that, I'm concerned. I think there might be a lull later this year in metal demand.
In terms of what's been going on in Mexico, if there is a resurgence in the fall, I would think you'd be better prepared now. And how do you expect that to play out if there is something, or COVID comes back in the fall?
I actually don't think the second wave is going to be anywhere close to the first wave. I think it'll be an echo of what we've just come through, at least in Canada. I'll qualify those remarks for Mexico and actually defer to Peter.
It seems like, based on the stats, that Mexico's just like still on the upward kind of trajectory of COVID cases.
I think what's clear is you have no idea what the stats really are for Mexico. That the government is doing a very good job of managing, or at least trying to manage, the statistics, and at the same time they're telling you that the level is at whatever the number is. You've got crematoria that are running 24 hours a day, and you've got people selling tacos in front of the graveyards who are saying they've never seen as many people coming in. So, I mean, the estimates are anywhere from 4 to 8 times more cases of COVID and people dying from it than the government is actually talking about. So it's really difficult to get a handle on what's going on. And I don't see that changing anytime soon, not because it's a medical issue, but because it's a political issue.
Is it central in the rural areas or in the city centers? We're seeing
Urban.
here, urban, yeah.
You know, much of Latin America, the population is clustered around the downtown core, and then outside of that are the barrios where the poor people live. And there's no such thing as social distancing. I know many of them don't even have basic facilities, power and water. So that's where I think there'll be grave damage done by the COVID-19 crisis.
To add to what Brad is saying, that social distance for sure is not something common in Latin America. But in Mexico, I've seen particularly in Sinaloa that local municipalities are controlling more the inflow and outflow of people from other regions. Is becoming more state by state. And some states I've seen, particularly Sinaloa and Northern Sonora, that local municipalities and the state government are handling sometimes better than the federal government, the COVID aspect.
Yeah, the governors have really stepped up and kind of played a strong role in providing solutions as best they can for the communities and industry.
Well, I guess we can move on from that depressing topic. I guess we've got a few minutes left before we wrap it up. There are a few questions that have been posed from the audience. One of them is, what are the prospects in Mexico to introduce renewable energy as part of carbon footprint targets? Are there carbon taxes in Mexico? I don't know who wants to take it.
Well, the answer to the second one is pretty easy. There's no direct carbon tax, but there has been an indirect one in that the previously subsidized price of fuel was allowed to float close to, call it, world price in the last 2 years. And that's effectively a carbon tax. With regard to renewables, the previous administration also significantly opened up mainly wind power, but secondarily solar power. And now this administration is actually trying to take back control of that sector because the government historically, at least in recent decades, controlled all of energy. And now they feel the control of energy slipping away. Peter, do you want to add to that?
Well, I mean, I'd just say that energy management has been a big issue for the mining industry in Mexico for a long time. And with my experience and what Fresnillo has said in the last few days is they're up to 75% self-generated energy. So, and a lot of that is renewable. So it's definitely a direction I think you'll see happen more and more in Mexico.
And then the last question was just going back to the question about how do you minimize dilution while coming up with a long-term strategy. So I guess it's just asking about how you think about future capital raises and growth.
Well, a higher silver price is more free cash flow, right? And you make room for a self-sustaining growth model there, where you can spend internal cash flow to do your drilling. Maybe you can see the ability to have more debt for acquiring assets, especially if they're producing assets, and you can service that accordingly. Given where the market's been for the last 5-10 years, dilution's been one of the only sources of capital, given how investor interest has been, very, very hard to find. So I think that's been the only option for quite some time. But, things start to pick up a little bit here. A lot of these things, a lot of options start to open up. And as Brad said, get a second asset up and running, commodity prices are healthy, your ability to take on some debt without materially increasing risk all of a sudden becomes a viable opportunity. So I think a bit more positive move in the silver price, and part of that question gets answered for itself.
And I think also return of retail investors to our sector. I mean, the retail investors got pretty badly beat up after 2002 12, if you want to call it that, and they just haven't been around. And now the funds seem to be taking a back seat, and we're starting to see more retail. And as Brad said, retail seems to be more focused on silver than the funds anyway. So having them come back is a potentially a major component to our financing our sector moving forward.
And I think, like, springing on from that as well, it's really kind of understanding where we are in the cycle, because we sometimes act like we're in just a business, like we have shoe factories, or we're, you know, making high fashion or whatever, and we're producing commodities that we don't have any control over the pricing of. We can't invent a better price of, or a better ounce of silver, a better ounce of gold. So it's really understanding there's time to be a buyer of assets, there's time to be a seller of assets, there's a time to look for you know, debt-based financing. You know, there's a time to be doing drilling, raising equity, because that's what's going to be most accretive for the stock. And sometimes I think the industry doesn't really kind of realize where we are on those curves of the cycle. And that's how you reduce dilution, by getting the right kind of financing, doing the right kind of thing at the right part of the cycle. And that takes a lot of discipline, and it's tricky, and your shareholders don't always like it, because they want their 10 bagger or their 2 bagger, their 30% return right now. But that's kind of the discipline of management of you know, making sure the shareholders understand why you're doing what you're doing now, and that in the long run, this is going to pay off for the best. It's difficult in the broader market now, where, you know, Apple's gone from $15 to, I don't know, whatever the unconsolidated ratio is, $2,000. Amazon's up at $2,600. But we get those returns when the market comes. We just got to wait for it. And it's not a continuous grind higher in this irreality that the rest of the market has become.
And to add to that, dilution is not just the number of shares out. Let's be clear. Dilution is relative to your ounces per share, your cash flow per share, your earnings per share. And I'll just give a quick lesson, a quick example. In February of 2009, when our stock was still horribly beat up, we had a chance to do a $14 million convertible debenture, because we had a second mine that we wanted to expand. And the all-in dilution was 12% on that deal. But the cash flow accretion that year alone was 36% growth of cash flow per share. And that's the definition of accretion, not dilution.
Right, and it's interesting now, I think, with all these financings happening recently, obviously you're getting these oversubscribed deals that have gone very well, but if you're bullish on precious metals in general, you could see this as kind of a waiting period to you don't want to take too much money in right now if you think you can potentially do a financing at a much higher level in a few months.
That's a tough one, though.
Yeah.
Things will be better in September. It's going to be
always good to take money if it's offered to you.
There's a window, and you take it when it's there. To be honest, to properly and be prudent with running the company, there's a window there, and if you can guarantee a couple years of aggressive work, you're set. You're not going to have to worry. There won't be an overhang on your stock. You'll actually get rewarded, I think, because you're now covered. You're not going to have to come back to the market to add value with the drills. So for an explorer, that's for an explorer. So it's a fine balance. Some shareholders are not happy. Well, why'd you do it now? You already have some money in the bank, and it's like, we want to, like, silver was $12 a few weeks ago. Sure, it's 16 now. It could happen again. You got to be prudent. Yes, you don't take too much. You take enough that you can, kind of, our number is to kind of be a couple years of very aggressive work and always keep a cash balance of over 10 million. That's kind of the number you have in your head. Internally, that's what we like to do as an explorer / developer. But it's a fine balance.
So the worst time to need money look for money is when you need it.
Completely agree. Exactly. Because you're going to get hammered.
I would say everybody here is highly, highly sensitive to dilution, and we've been very active for the last couple of years. And many of the times where we raised money, it wasn't raising the amount of money we needed. It was raising the amount of money to make sure that the deal was 3, 4, 5 times oversubscribed, so that the stock performed really well afterwards, so that our shareholders are participating while we're still doing what we need to be doing to move the project forward. So it's again, everybody here is very aware not to suck every last dollar out of the market and leave the shareholders holding the bag. That's not the way, everybody here tries to do it. So, you know, taking some money, delivering some catalyst, if there's a good deal to be done at a higher price, you do it. Again, it's one of the very few industries where you have to raise all of your money before you get your first penny of revenue. And there's not many industries like that. So there is a slow marching up of getting your money in the door. And if you can kind of inch it forward and get to the finish line incrementally, then it's kind of the way it goes.
I think because we have seen a few large players coming in and taking a lot of the financings down, you're seeing a lot of people buy in the open market because they're just not getting the opportunity to buy on deals, which is great for all of you. I think unless Tina has any more thematic things, we can just maybe get each one of you to talk a little bit about your project, just to remind the audience of your selling features and what you're up to over the coming couple months, just list some catalysts. Taj, why don't you kick it off?
Yeah, this is Discovery Metals. Their flagship project is the Cordero project in the Chihuahua state. We're aggressively drilling, doing about 35,000 meters this year, probably going to do more now. Based on the recent financing, and our ultimate goal is to put out a brand new resource by about this time next year, and a PEA a quarter after that. And as you know, Cordero's one of the world's largest silver projects, just by silver alone, but also by silver equivalent. It's fantastic at $25, $30 silver, billions of dollars worth of NPV, but we didn't acquire it for that. We acquired it to make a project work at 17 or 18, and then it's got some added optionality. So our focus really is making a high margin project with scale that's going to be a completely new Cordero.
Thank you, Taj. Bradford, why don't you go next?
Yeah, I'll talk about 3 mines with falling cost profile and a rising silver price environment creates great cash flow leverage. 2 development projects to over the next 3 years, build 2 mines with more than double our production and half our costs, and 3 admittedly early stage, I call them home run projects in Chile, world-class prospects ready for drilling. Those are the 3 main value catalysts for Endeavour.
Okay, great, thank you. Peter, do you want to talk a little bit about Reyna?
Reyna Silver, we're the new kid in town. Got 2 district scale potential high grade exploration properties. Nice treasury to go explore them, and we're champing at the bit, and we're already rolling. So what will happen is going to be proven or disproven by the rotary lie detector.
New kid on the block, but obviously a seasoned mine finder. Brendan, do you want to talk a bit about Excellon?
Yeah, so we've just done this acquisition of Otis Gold, which has the Kilgore project in Idaho, 1 million ounces at 0.5 gram oxide, but it really kind of completes our growth pipeline. We've got production from Mexico's still highest grade silver mine for the next little while. Between Mag and SilverCrest, there's some definite competition. But that gives us just great exposure to the silver price, huge leverage to the metal we've been talking about for the past hour or so. Our gold development asset, we believe that's kind of the foundation for full participation in this precious metals bull cycle. Long may it rain. But a project that we think has 3 to 5 million ounce potential as well. It's kind of similar to a Round Mountain style deposit, which has produced 15 million ounces since 1977. And then the latest thing coming up is our Silver City project in Saxony, Germany. And this is a project that was mined for 800 years. Mining stopped because of the Franco-Prussian War and Germany's shift off the silver standard back in 1873. And we can go through the whole history, but basically they were mining up to 10 meters at multi-kilo per ton silver. We've got a university and a high technology institute that we're working very closely with to bring exploration back to this region and show how, it wasn't geological, metallurgical, technical reasons why mining stopped. The mineralization didn't run out. It's still there to be found. And the first drill program ever on the project starts in just a few weeks.
Thank you. That sounds exciting. And Marcio, do you want to talk a little bit about GR Silver?
For sure. like Reyna Silver, just a young company at low valuations, but with a lot of upside potential. Today, this company controls most of the Rosario mining district, which is a big advantage to make a solid platform to grow. And Plomosas, a lot of people have said to us that was an old mine, but it's an old mine with more than 20 targets and 500 drill holes, 100,000 meters of core. And doing basic geology, we have discovered silver and gold in a project that had only lead and zinc reported in the past, showing that there are more to be discovered and add value to the company and bring return to the investors. And Mexico is where we are going to be. Rosario Mining District is the portfolio.
Okay, thank you. And Chris, do you want to wrap it up for us?
Sure. For SilverCrest, I think the big part of the story is we've made really big strides in the last few years at reducing risk with our permitting, our economic studies, our financing, with the team that's done it before. And again, a unique part of our strategy is, part of that re-rate that tends to come with production. We're going to be drilling and growing aggressively throughout that same timeline. So you're going to have the re-rate to production, hopefully, at the same time where the resource growth story is still in the early innings. Again, so an asymmetric risk reward, hopefully, on something of a sector that's hopefully going to just get kickstarted here.
Okay, great. Well, thank you all. Is my mic cutting out, Tina?
You're good.
Okay, sorry, I was getting feedback. Thank you all so much for participating today. It's been a real pleasure hosting you, getting to know your projects and yourselves a bit more. We will make all the individual company webinar replays available probably next week. We're going to keep our editor busy, and we'll also have this panel available as well. So thank you all for participating. Thank you, Tina, for doing all the heavy lifting. And also a shout out to our colleague, Victoria, who would have joined us today, but she actually gave birth to her first little boy on the weekend. So congrats, Vic. We love you, miss you, and everyone have a great Thursday. Thanks for participating.